Hello traders, it's Samurai Trader here. In this session we'll be covering a great deal of information, so if you could please ensure that you have a pad handy and a pen, because I'm sure you'll want to take down some notes. And if I'm going too fast on some things, please rewind or go back a little bit and re-listen to it again, because these three particular setups and strategies are all closely related together, and at times they'll actually fire off at the same time, or maybe within a very short period of time within each other. As always, I need to show you the disclaimer that trading does carry risk, and I have to say that is what proper training is all about, is to minimize that risk. But please feel free to put this film on hold if you wish to read that disclaimer in detail. It's a required government disclaimer. If you haven't already done so, if you could click the lower bottom right hand of your screen and then expand to full screen, as we'll be covering some very important information in this recording on three absolute essential trade setups. Now, small daily improvements over time lead to stunning results. I once read that for you to become a master in a skill, and this was relating to music in particular, that it takes 10,000 hours of practice to become an absolute master. Well, thanks now to the art of what we call modeling, which is enabling you to copy exactly what someone's doing, you can really minimize that, the time period that it takes to reach master level. Now, small daily improvements over time lead to stunning results. That is, to become a master, what I want you to do is to become a master at these three setups before you move on to any others, because these are truly the foundation of highly profitable trading and true success as a trader. These trading setups work on all markets where we have some volatility. Volatility and volume is critical, of course. You don't want to be caught in a tight trading range. That makes it very, very difficult to make money. That works as I mentioned, on all time frames and all types of charts, whether you be trading time charts, range, tick, Renko, it doesn't matter. We have a number of indicators that we use that I'll show you on the chart. We use the slow stochastic, and we have a faster slow stochastic overlaid over each other. So that is, we have a slow setting of 5, 3 and 3, then we have a fast stochastic laid over that of 20, 14 and 1. This is covered more extensively in a video where I cover the indicators that I use. On the chart we also have a 34 EMA, a moving average, we have the 89, and we have the 200. You'll notice on my chart I also have the fractals on there, and I also have the standard floor pivots are also on the screen. Money management, as you know, I have a maximum of 2% risk at all times. If your risk on your account is any higher, either you should not be trading, or because the stop, if it needs to be too far away, sit out the trade. It's not worth taking the trade. Trading is not rocket science. Trading is only a pattern solving exercise. So after a period of time you'll get to learn these patterns, as they're very mechanical in their approach. And one thing I love about rules-based trading, it removes a great deal of the emotion from trading itself. So let's have a look at some actual examples on the chart. Now what we're going to do is we're going to start, I'm going to give you a number of examples actually, so you can apply it, because some of you of course are going to prefer to trade share bars over range, etc. So what I've done here is remove the MACD that I normally have. So I've just got really the minimum amount of indicators that I'd like to see in just taking these three trade setups. So many of you of course that have watched me live trade or that have attended my seminars will notice that I've removed the channels, for an example, from here. So some of these, you'll recognize some of these setups automatically. As for an example, right here we have a 200 EMA bounce. The purple line is our 200, the cyan is our 89, and the yellow line is our 34 EMA. So they're all EMAs. And this particular cyan, this is our zero lag indicator. Some of you, if you don't have zero lag on your charting package, you may end up using, for an example, a 7 EMA or an 8 EMA and following that and its turns for trend direction. So we can see here we've got very clearly a bounce off the 200 off the 34, and we've got a bounce off the 89. Now if we look down here at our black line here, which is our long-term stochastic, we can see that is turning up. So what I've got here is a short-term stochastic, which is a setting of 5, 3 and 3, and we're waiting for this to roll over and point up in the direction of our trade. And I have a long-term stochastic which is overlaid, which is a setting of 21, 14 and 1. So what we're looking for, this first trade that we're actually looking at, is a money on the floor, or as I call it, a T10. And as a reminder, I give codes to all of my setups. It just makes it easier when I'm coaching clients. So if we have a look at here, we had this rollover. Coincidentally, a few seconds later we had the paint bar. Now that paint bar, you can see there, would not have appeared until this third candle ticked up above these two. Okay, so if you wish, you can ignore that paint bar for a moment because that wouldn't have appeared. So our first trade setup that we have here is a money on the floor. To go through it again, my long-term stochastic is rising, my short-term has come down. It doesn't necessarily have to have crossed through the long-term, but I do want it to roll over. And what improved the odds of this particular trade is I also have a bounce of all of the EMAs. So what we can see here, we've got very strong support in this case. This black line we can see here is a floor pivot. Over here we can see we had a bounce off the pivot, and here we've punched straight through it. So there's been really strong support. So we've gone up and above. Now what we had set up a few moments later was a T1. A T1 is where we have a paint bar appear. Now to have that paint bar appear, it doesn't appear until we have an uptick above the second candle. Candle 1, candle 2, uptick, then the paint bar would appear. So that is also a T1. Now let me just scroll back a little further. Now this is almost an area of confusion because you're not sure if you're in an uptrend or a downtrend. The only thing that really gave you a trade that qualified here was your rising stochastic, because your 34 EMA is virtually sideways and your 89 is sideways. What we did have form down here was a double bottom, a T7. See that there? So that is actually giving you a good indication of a real support level at this point. Now remembering, I'm going to cover in this video, and I'll probably maybe even do a second video on these setups, a lot of information. It may go over your head initially. You'll have what I call, once you watch it a number of times, excuse me, you'll have a number of what I call aha moments. Aha, that's how it works. So please persevere, don't give up. So moving along, the long-term stochastic become overbought. Now remembering, when I say overbought and oversold with the markets traders, there is no such thing as an overbought or oversold market. It's a term that is loosely used. That is, who knows where the market's going to end, who knows how far it can go, but we use it as a term. Now I say that because of the experienced traders watching. Some may have very strong opinions of the terminology, but persevere with me please. So let's now have a look at our next setup, which is a T2. A T2 is a slingshot. Now we can see here, and let me just scroll this over here. Let's go to the far right hand side of the screen for a moment, because this is what you would see effectively. You can see that the short-term stochastic has come right back down, pulling back like a slingshot. You can see here we're well above the 34, which I'll talk more about in a moment. And so you're getting this slingshot, a pullback right back here, and you can see that my long-term stochastic is overbought. Now your entry point, you would actually wait for a couple of things. First of all, do you notice how this candle is a red candle? I'd be waiting for a green candle. I want to have a confirmation, which actually would be this candle here, the next one. I do want to have confirmation that the candle is closing, A has closed, and B is closed in the direction of my trend or trade. So let me say that again. I want to make sure that the candle is closed, and I want to make sure that it's closed in the direction of my trade. Now there is one other thing that is optional, and for new traders I recommend that you wait for as well. That is, you wait for, if you're using a zero lag, and the zero lag, by the way, has a setting, if you're wondering what, of 21. This is covered in the indicators video, but anyway, this is a 21 zero lag. Now instead of a zero lag, you can also use a hull, and let me see if I've actually got one here. Here we go. I've got a hull MA here. So you can also use a hull EMA. Let me just pull that up, make that left axis. So a hull MA is another indicator that you can use. Now here you just want to make it more sensitive. Okay, so I've made it a 21. Excuse me, traders. Let me just maybe fine-tune a little more to a 17. Okay, so I fine-tuned it that it almost matches the zero lag. Now a hull moving average is a very common moving average, and you can see it changes color when it rolls over and when it turns. A hull is used along with a zero lag as a trend turning confirmation. That is, it's assisting you, informing you that the market has turned. That is, that there's a good chance that we're going to continue in this direction. So let me recap. You can wait for either the hull to turn, which it turns on this one, or for your zero lag to turn. Now check in your charting package. You should have these as standard packages. If not, Google them, as nearly all of these are available free of charge. So before you go out and buy any, you'll see lots of people selling the hull and selling the zero lag. In many cases you can obtain these free of charge. There's so many forums now for different software packages that you can obtain most of these free of charge. Now when it comes to using the zero lag or the hull, and you can see our entry signal was here, you would not have had, that is, the zero lag would not have confirmed until this candle here, which means you've had a good 5 to 6 ticks of lost profit. So here is a consideration. If you enter when you initially have a signal without waiting for a secondary indicator such as the hull or the zero lag to confirm the trade, your stop is going to be smaller, because here you would have entered at the close here. Your stop in this case, I would recommend, is below this little swing low, just like down here would have been a couple of ticks below here, a couple of ticks below here. So we want to place our stop just below these little swing lows. Now so it would have been from there to there, yet if my entry is here, I have a smaller stop as well. Now the zero lag will keep you out of a number of losing trades, which can be great for a newer trader in building your confidence. However, on the other hand, when you enter trades earlier, it's more pure price action trading, you can have higher profit targets as well. So if I'm going to enter a trade much earlier, I will increase my profit target, as an example, from maybe 13 or 14 ticks to 20, 21 ticks. By doing that over time, that will actually dramatically improve your bottom line, your profitability. Now remember, there are no magic indicators. Indicators are tools. The reason that so many indicators work so well is so many people use them. They're almost psychology driven. So indicators, and you've heard me say this before, it's the second mouse that catches or that gets the cheese. The first mouse that goes into the trap quite often gets caught, usually does. The second mouse comes in afterwards. That's what an indicator will do. It'll get you in a little later, but it's going to save you on some trades. And this really gets back to doing your testing, your back testing over a period of time. Now our next trade here was actually here. Now it's getting a little rough because see how our long-term stochastic starting to fall. Okay, so you'd start to get a little concerned here by this, because when you take a T2, you really like to see your long-term oversold. One thing I didn't mention was this. Down here we also had our very first trade, our T1, also appear. So here we had a T2 appeared on this candle. That would have been, and you may have waited until this candle for your entry, but we also had a secondary entry which would not have appeared, that is the paint bar until this signal, called the T1. So you can see here we've had two signals to go with the trend. Now what are we using here? And let me just remind you how we're defining our trend. Our trend here is being defined by our yellow line 34 EMA, our cyan, which is the 89. For 200 can be useful, but it's a much later or lagging moving average. Now if you want to simplify your charts, you can use a 200 as an example for what may be happening on a higher time frame. Now I cover anchor charts in another video. All of these trades are much safer if taken in the direction of a higher time frame. That is, if and as an example, I'd usually want to have a anchor chart a minimum of 3 times higher in time. So where I've got a 233 tick, I'd want to see a tick chart, this is a share bar chart where I've got a 233 share bar. Let me get this right. I'd like to see that at least 3 times that as an anchor chart. We'll get to the tick and I'll talk more about anchors and tick charts very soon. Now we then had another signal here for a T2. It's not ideal because notice how our long-term stock has fallen. We've got the rollover. In actual fact, you still would have been in this trade. Okay, you wouldn't have got your minimum of 13 to 14 ticks. Now remember, your risk reward, your target must always as a minimum equal your risk. So therefore, if your risk is 13 or 14 ticks, your target must be at least 13 or 14 ticks. The only time will be an exception where you might get out earlier, of course, if maybe the trade slows down. And I always say time is not on your side. My belief is that I want to see my trades follow through. I'm a momentum trader. I'm a sniper. I want to get in, I want to move quickly. I want to know that I've got momentum on my side, because if the market stalls, well, I never know what it's going to do. There's a very good chance it may be reversing. So T2, T1, a rough T2 when you see these rough T2s, you want to be very, very cautious. Now let's just scroll over a little here. Here we have another T2. Now a couple of things we want to look at here, and let me just pull this down. Okay, yeah, it's all right. Is we've got, and you can't really see this, but we had divergence forming, and one of the things you want to be very, very careful of is divergence, because there's a chance that the market's going to roll. So what we had here, we actually had a T2, and you'd be excused for if you actually took this trade, because what you also had was a T1. So you had once again a T1 probably signaled at the same time as a T2. What was a T1? Well, remember, you've got a paint bar, or you've had two candles, two up candles, and a tick above them. Now if you don't have the paint bars on your package, and if you haven't been able to get them, of course John Carter talks about this extensively in his book, and in his particular case he waits for 3 higher closes. I like to wait for 2 higher closes, and I call it the rule of 2. That is 2 candles closing in the trend direction, and then I have a third candle with ticks above them. That is what qualifies. So I want to have 2 candles closing higher highs in the direction and a third candle above. That is why you don't have to, it's a simple setup, you don't have to have the paint bar. And remembering, as a reminder, the paint bar would not appear until I have an uptick above here. So it can be a little deceiving. Some people think it appears here and what a great signal, but it is a little delayed. The setup is sound, it's a great setup, it's a brilliant setup, but the paint bar does not appear until the third candle. Excuse me. Now in this particular case, you would have been stopped out on this trade. This is a lovely profitable trade. This was a lovely trade. This one you got stopped. Now what we've also got happening here now is the market is starting to roll over, and so you've gone up here, it's rolled over, you can see the zero legs rolled over, but now I've got what I call a lower high. Here's a higher high, this is a lower high, so we can see it's starting to fall away. There is another signal that the market has a strong possibility of falling away, and it is this. Notice our short-term stochastic, my apologies, our long-term stochastic did not go into the overbought territory. Notice that there, and natural fact it rolled over, and you're almost, and this is actually, I call this a T11 setup, because I've got a paint bar which would have appeared here, a lower high, paint bar appeared there, we're rolling over, it's almost a T10, because remember with a T10, a money on the floor, we want to see our long-term stochastic roll over, start to fall away, and I like to see the short-term stochastic come up and roll over. This one you'd be excused for not taking because it wasn't a perfect setup. Now over here we then had a lovely T2. Now the T2 signal actually appeared a little earlier. We actually ended up getting a T1, see the paint bar, which wouldn't appear to here, but notice how our long-term stochastic goes into the oversold territory, our short-term comes up, rolls over, and then falls away. There's also something else happening. Look at our yellow 34 EMA. Notice how it's rolled over, and what direction is our 34 in? It's now heading down. There are trading professionals all around the world. Many have made millions of dollars just working with the 34, waiting for it to go through, come back and kiss the 34. That's what they call it, coming through, bouncing up and kissing it. Natural fact, just here you had a 89 bounce, but there are a number of reasons to be concerned for that is our 34 because of our roll. So getting back to the main trade setups we want to talk about, so right there we had a T2 because we've gone up, rolled over, and we ended up getting a T1 signal as well, our paint bar. Now where you see these setups, quite often you'll see a lot of support or resistance in this area to go through, because you're hitting the 89, and then down here you've got a pivot, and you've got a 200 as well, but it went through. So let's go along here and let's have a look at some more setups. Let me just scroll right along. So what's our next setup? Well, I like to see, well, this one here you still would have been into somewhere down here, but the next one would have been here. Now the qualifier to qualify for a T2, as I mentioned, I like to see this long-term stochastic oversold or overbought. It's coming up. The minimum level you want to really see is 50%, which is about there. So it's about there, but notice how we're coming back up again. So it's just a danger area, and once again you still probably would have been in this trade. And just a little money management hint, remember price travels quite often from pivot to pivot. Now we can see here we're heading towards a floor pivot right here. Now those that are familiar with my work know that I'll quite often front run. I'll have my profit target 1 or 2 ticks above for at least my first lot of contracts, because quite often you'll come down, test that pivot and bounce. Now here we had a bit of a bounce for a number of reasons. You had the 200 and you had the floor pivot, but then we bounced around and then we continued. So what we've got here is a T1 and a T2 signal once again. The T2 appeared before the T1, so the slingshot appeared first. Why? Because remember, and I know that I'm repeating myself because repetition is the skill of learning, the mother of skill. So I'll repeat these time and time again just to help you learn. So the short terms rolled over the second on the second candle. Remember, until we get a tick down on the third candle, we wouldn't have had the paint bar appear. So here you also had a paint bar appear, so you had both a T1 and a T2. Here you would have easily picked up your 14-15 ticks, then you had another one. Now your signal would not have been until this candle right here. Let me just get this here. Notice you're waiting for this rollover on the short term, your 5, 3 and 3, and you would have also had the paint bar appear at the same time. So you've got a dual entry. You've got two things signaling your entry, as well as, of course, you've got your zero lag confirming. You notice here it goes from magenta, turns to cyan for a moment, magenta, cyan, then rolls over again. So you could have ridden this. Now one of your profit targets, of course, can be down here, once again your next pivot, okay, right down here. Now if we go across and look over at our chart, we can see here that we've already been well and truly down. That is, these are areas that we've already touched. So as far as profit targets, and we cover drawing horizontal lines for profit targets in another video, there was some really great logical spots right down here to aim for your target profit targets themselves. So coming back down here again, now remembering, even though I'm showing you a lot of trades here on the NQ233 share bar, this works on all time frames and all markets, so it doesn't matter what market. We're going to look at others in a moment. So what have I got? We can now see that the long-term stochastic is well oversold. I've got a rollover. You may not have got until that candle. It's so between there and there. Either way, you had both a T1 and a T2 signaling. Now a little word of warning: the market generally works in waves, and what we've had here is 1, 2, 3. This is our fourth trade in a trend, and if you wanted to count up here your T10, you've had 5 trades in a trend. After your first 3 trades, please proceed with caution, because what actually happened here was we ended up having to bounce up here. It wouldn't be surprising if I had the MACD on here if we actually had divergence. Why don't we have a quick look at that? Let me just quickly pull this up. Let me just for a sec. Oops, this sometimes happen with TradeStation when you go to overlay another just pull that off. Just give me a second, traders. So I've just put on my platinum MACD. Yes, we're starting to get a bit of divergence. It's not fantastic, but we can see here that our MACD is going from being well oversold, starting looking at zero, and here it is actually crossing the zero line. Now, just while we're on this, when we have the platinum cross the zero line, this within itself can be a trading strategy, and many traders actually use it as a trading strategy. So you can see here you're crossing the zero line right at this level. So in other words, if you're in a trade here, you'd be strongly considering exiting the trade. When you've punched through here, you've got strong divergence, an MACD zero line cross, you want to be very cautious, and your 4 to 5 trades in a trend. So you've come down a long way without a decent pullback. So let me now remove this here. Let's go back down to this. So where's our next trade? Well, then up here we've got our 34 leveling off. We've had some profit taking, we've come back up again, and here your long-term stochastic is coming up. So you're actually getting a T10 setting up right here, a T10 trade. What is that caused by? Well, our long-term stochastic is rising, our short-term has come down and flicked up. Now, where would our stop be in this particular case? Well, our stop needs to be down below, at least 2 ticks below this little swing low. So let's just have a look at this for a moment. So we had a close of 36.50, a low of 33. So my stop there is going to be at 14 ticks down there. So my stop would have to be here, and I would have still been in, even though this tick down 1 tick below that low. I'm still in that trade if I took that T10. In natural fact, then you had what? If you had taken that trade, okay, you had a T2. Notice we've gone up, my 34 started to rise, I'm sort of going sideways, it's virtually a pivot bounce as well. So then I had a T2. So remembering here I'm using my 34 EMA as my main trend direction. So let me explain a few important things that are happening right here now. When you go up to your 89, and you're going to see this regularly, and even over here you can see it, and you can see for 200, when you go up and hit these levels, these are very strong areas of resistance or support. So a couple of things have happened here. We've come off and we've bounced off the pivot level. You can see that there. I had an entry if I wasn't already in this trade, which was a borderline trade anyway, so you could be really excused for not taking that one. Well, here you had a perfect T2. Now a T2 is a trend following trade. Now here you've got your 89 coming down still against the trend, but my 34 is rolling. Okay, so it's what I'd call a B class trade. Now if you were in this trade, you want a front run, that is, I'd be setting my target just below this 89. Why? Because there's a very good chance you're going to have resistance at the 89. So here you've got a T2, up you go, and then you ended up having a T1. Now to be extremely safe in taking T2s, if you just followed the 34 and the 89, you would have been discounted out of this trade. Here I'm talking about what I call the law of probabilities. I know that in all probability I'm going to make money on this trade, even though it's a lower probability trade. Why? Because my 89 has not turned as well. If you want to be extremely conservative, make sure that you only take T2s in the direction of the 34 and 89 if you want to be really conservative. For T10, you're justified because a T10 is a change in direction trade. Your T2 is a trend following trade. So I hope that all made sense. We'll cover that as we continue to cover. Now, what I did have here was a T1 in the direction of the 89. If say a T1 or an 89 bounce, which if you haven't watched the video, you'll see the 89 bounce is a highly profitable trade, and we take them every day. Once you've mastered these three trades, I should put that in. It's a trade that I take every day. It's a great trade, a high probability trade, but please do not take the 89B, I call it the 89 bounce, until you've mastered your trend following trade. So your other trend following trades. So we've gone up, we're bounced. Now what have I got down here? Here I've got another entry. It's both a T1 and a T2. Notice how sorry, my apologies, this is a borderline T10 and T2 and a T1, so all three in one. Why is it a borderline one? Notice how the long-term stochastic is falling, the short-term has come up and rolled over, but I'm not fully oversold yet, so that makes it a T10, which is a money on the floor. As soon as we tick down from there, we also would have had a T1 signal. The paint bar would have appeared. So that improves the probability of that trade again. I love it when I have a T10 signal and the T1 confirms a trade. So remembering with the T10s, you've got a stochastic of this that is trending in the direction of your trade. Now down here you then had another T2. This one would have failed. Okay, you would have failed on that particular trade. And why is it a trade? Well, there of course we're oversold, we've gone up, we've rolled over. Okay, I've still got magenta here. I wouldn't have been surprised if I had some divergence on our MACD here. But also is to consider, you've also had a lot of trades in this trend now. We had 4 or 5 over here, 6. Okay, you could have actually almost taken that one as well. So you're really reaching a point of exhaustion at this stage. So moving along, what have I got here? What direction is my 34? I'm really starting to trend up. What is my long-term stochastic doing? It's really starting to trend up, and I've had a short-term rollover, point up. I've got a very distinctive, what is this one? A T10. It's a T10 because the long-term stochastic is in an uptrend. My 34 in this case confirms it as well, and just coincidentally I end up getting a T1 signal appears. Remember, that wouldn't have appeared until a tick above here. But there is one negative or one challenge about this trade. Look at this 200. See how it comes up and I bounce around. So you want to be really careful of those and consider taking profits or bringing a stop up type once you're in the money. So then we take some pressure, and within itself we actually have a 200 bounce trade actually qualifies here. So you've got conflict. What do you do? Well, personally I would have stayed in the trade. Let's just have a look at this here. The low is 33, low there is, let me just check that, sorry, low of 33, low of 32.75. Now remember the stops I spoke about, traders. Where does the stop go? 2 ticks below your little swing low here. That tick down 1 tick below. You would have been saved by the chinny chin chin, just a fraction there. So it went down 1 tick. You'll see this happen all the time. So you hear me talk about on the NQ, have your stop 2 ticks above the high or the low. So if you had have taken this, even though going up against the 200, you still would have been in that trade. If you hadn't have, because you were so close to it, you had a bounce and that would have been a profitable trade. Then you had another trade here. Now what was this one? Well, this is borderline on a T2, but also you had a pivot bounce. And what direction am I in? My 89 starting to rise and my 34 is rising. Now with these trades you can see that there is discretion in everything, and that's why I always say these are 90 to 95% mechanical. The things I'm looking for at all times: do I have a trend? Am I in a trendy market? Do I have a lot of angulation or divergence against me? And I cover this in my divergence video that you have received. So there's always some discretion, but what will keep you on the right side of a ledger in a big way is by following the 34 for your trend direction. Now when you go back and before you start to trade these live, you're going to run and take at least 100 of these trades of each setup, not all three combined, of each setup flawlessly according to the rules. Now when I say flawlessly, yes, you're going to take some of these and they're not going to work out, but you've got to take them according to the rules without taking impulse trades. Remember, you're looking at the greatest career opportunity of your life here. So practice makes perfect, and discipline is a muscle. So let's go back and look at some more trades. I'm going to let this video go another 5 minutes, then I'll go to another market and do a second video on these setups. So let's have a look here. So we can see here we've come down, we've curled up, and this basically, and let me just go and have a look at the level, it's a borderline T2. Now it's not a great one, and the reason I really like to see a decent pullback, you don't have to, but I'm going to look at one other thing that I'd normally have on my chart. Now normally speaking, I would have my channel on here. Okay, and let me show you something here. You can see my 21 EMA channel, which we use extensively in our T69 setup, which is another video. Notice how this entry here, I was fairly close to the channel, but notice here how my price entry is starting to get well out of the channel. And this is one thing, once you get used to it, I'd like you to consider leaving, and you can see it here as well. The further out of the channel you are, the greater of a chance you have for a snapback or a pullback to the mean, pullback back into the channel. Now in this particular case, look how we're really starting to move well out of the channel. Now on your, and I'm 99% certain on your traders checklist, it's one of the key points, one of the things I have typed down. Please write that point down. Make sure or ensure my price entries are not too far out of the EMA channel. So just consider that, because the further you are out, the greater of a chance of springing back. So let me and actually what I'll do now I've introduced, so I might just leave that in there for a moment. Now what's happening here? Well, up here traders, we've got, and T7s we cover in another video. Let me just have a look at something here. And by the way, just while I do this is something you might want to have a look at. Quite often you'll have pivot points you can't see because you're above your screen, as they are in this particular case. So sometimes you need to pull price action down, you can do that a number of ways over the side here, and there's a lot of ways of doing it. So on your own charting package, always be looking, where are my floor pivots? And floor pivots are in every charting package. So what have I got here? I've got a lovely little almost a triple top forming here. Now quite often price will be heading up towards a pivot. It didn't make that pivot. Pivots are not perfect, it's a guideline, and we can see what's happened here. I've now formed a triple top, and away I go. Now here it would be quite, and in many cases we take these all the time once you've mastered your other setups. Double tops and triple tops are a fantastic trade. However, traders, learn from your mistakes. If you've just purchased this and you haven't made it to this stage, or if you're a brand new trader, do not start taking double tops and double bottoms yet, because they're a counter trend trade, and a lot still fail. So your money risk reward has got to be different. So we cover that in another video anyway. But getting back here, the point I wanted to show you was this: we had a double top form, then basically a triple top form, and I've got a falling stochastic long term. My short term comes up and rolls over. So what does that give me? A T10, a money on the floor. My long-term stochastics rolling over and falling. We can see here I've had a triple top, which I'd be rubbing my hands together with glee on this particular one, and away it falls. And down here, look what then this beautiful setup I then had. So that was a lovely trade. My first profit target, by the way, would have been, where's the next area of support? The 89 and the 200. See how they're converging here? See how the purple line and the cyan are converging? That's a very good sign that we're going to get a bounce, which is exactly what happened. We bounced up, we then had another formation, and you wouldn't have been into that candle. Remember, I wait for the candle to close. The amount of times I've seen a candle looking great, then all of a sudden it goes back, and particularly on a bounce too, you want to be very careful. Then we had a beautiful, it's a cross between a T10, because we're not quite oversold yet, and a T2, but then bang, it punches through. And then what do I get down here? I get another lovely T2 again. I'm oversold on my long-term stochastic. My short-term comes up, rolls over, and away we go. And I have to, let's have a look at this here, and then we have another one. Now this one here doesn't appear till there. Okay, we come down, and what's the warning area here? Of course, we're right on a floor pivot, so you want to be very, very careful. And here, as you know, those that know my trading style, I actually would have had a profit target just above our pivot here, but it then comes through. Now there's another little technique that those of you who have done or attended my seminars know, the rule of two. So I've got a beautiful rule of two there as well. I've got a beautiful rule of two there, got a rule of two there, but this disqualified because it's so far out. Now remember earlier I mentioned about profit targets and aiming. Notice how profit target once again has come right down here. My minimum target per day is a minimum of $200 per contract, and I never risk any more than 2% of total funds. So I can be trading 3 or 4 separate trades before I exceed my 2% rule. Now these ones here are the ones where you really bring home the bacon, particularly when you get a new wave. And let me call this a wave, because notice how we've rolled over, we've bounced up. Your first wave and second wave are your best profit making opportunities. Let me say that again. All right, wave 1, wave 2. Generally speaking, 95 out of, if you roll over properly, here you've rolled over, you're 34, you come down, you've pulled up and bounced. this is where you put the farm on the line. Now I say that tongue-in-cheek, traders. Once again, you must strictly adhere your money management rules. I personally believe as you build your account, you want to get to a stage where you're never ever risking any more than 1% of your trading capital in any one trade. 0.5 is beautiful, because that means you can have 5 losing trades and only be down 2.5 to 5% maximum. You're not sweating when you take the next trade. But getting back to the point, notice here our 34 is rolled over, we've punched through, we've gone up, we've bounced. That's wave 1. Wave 2, there's some of your best profit taking areas or profit making areas that you'll have, and you go and you'll pick up 21 ticks, which is $105 on these sorts of moves. 2 trades, you finish for the day. So traders, what I'm going to do, I'm going to stop this one, call this video 1 for these setups, and let's go on and look at another chart. See you on the next video.